Welcome to another episode of Goldman Sachs Exchanges Great Investors. I'm Allison Mast, Chairman of Investment Banking within Goldman Sachs's Global Banking and Markets business, and your host for today's episode. Today, I have the great pleasure of sitting down with Jon Winkelried. Jon is the CEO of TPG, one of the world's most prominent and most admired alternative asset managers. Jon is also no stranger to this building. He spent 27 years at Goldman Sachs, ultimately serving as our president and co-chief operating officer. Today, we're going to talk about the growth of alternative investing, the future of capital markets, and what it takes to stay on top of your game during a decades-long career in finance. So, Jon, thank you for being here and sitting down with me today.
Thank you, Allison. It's a pleasure, and it's always a great experience for me to come back to Goldman Sachs. I love it, and it's played a big role in my life, so it's great to be here.
Well, we're happy to have you here. So I want to talk about TPG and the private markets and start with some impressive growth stats. You joined TPG in 2015 and doubled the size of the business before taking it public in 2022 with $110 billion of assets under management. Today, just a few years later, you stand at $224 billion assets under management. And I'm sure our listeners have all heard of TPG, but for those who might not be as familiar with the business, can you give us a look inside and tell us a little bit about what has driven that growth?
Sure. So when you think about how TPG was founded, TPG really grew out of a family office and family office mentality. So remember that most of the other large private equity firms that became alternative asset platforms, their origin was people who came from Wall Street, people who came from where, frankly, we came from, and saw the opportunity in private equity and built these great firms. TPG really started by David Bonderman and Jim Coulter. The origin was the two of them working together for the Bass family in Texas, really very much of a family office mentality, which implied a lot of range and flexibility and being creative around where they would allocate capital. And so they came out of that origin, and it's not coincidental that they decided that they were going to build the firm on the West Coast, not the East Coast, which frankly, when you think about the ecosystem we live in, the relationships that we have.
Where the banks are.
Right, exactly. Where the banks are, where they're not, who we run into every day, how we think about things. It certainly has had an impact on both the orientation around what's interesting, how we invest, and it's had implications beyond that in terms of how the firm has grown. So that's then led into how the firm thought about incubating new businesses, how we've gotten into new businesses. So as an example, after the financial crisis, the real estate business was started because there was really an opportunity that we saw to do some interesting things that were, I would say, more private equity-like in the real estate world. Mm-hmm. And because of valuation, dislocation, et cetera, what we did is we actually seeded the origination of the real estate business by allocating capital from the buyout fund and getting there that way. Similar to what we did, for instance, when we seeded our first credit business. When Alan Waxman came to TPG from Goldman Sachs and started what is now Sixth Street Partners, the first $1 billion of investing actually came out of TPG Capital 6, which was the buyout fund. And that happened also after the crisis. So this evolution of trying to see opportunities in the market and move into businesses where we thought as a result of the investing DNA of the firm, we felt like we had a reason or an edge to be in a particular business and saw opportunities that led us into those businesses.
So you've discussed several tectonic shifts that are fundamentally reshaping the alternatives markets. What are some of those key shifts, and how do you see them shaping the industry in the near term and the long term?
Yeah, the plates are rumbling for sure in terms of how things are changing. One is that there's clearly a trend toward consolidation and concentration in our industry. And that is also being exacerbated by the fact that we've gone through a market change where, frankly, capital formation has become more difficult. So if you look at what's going on, first of all, the largest pools of capital in the world, and that includes institutional as well as mass affluent, high net worth, private wealth, the largest pools of capital want to do more with fewer managers. People want to concentrate and focus their relationships because they feel like they'll be important to their GPs that way. They'll get better terms. There'll be more strategic dialogue, top of the house relationships, as well as relationships through the deal teams and through the investing functions. And as a result of that, we're having to pull back in terms of giving capital to smaller boutique style managers. You're starting to see that manifest itself also in M&A activity in our industry.
Right.
Another big shift is this coming together of alternative asset management and insurance. The reasons for it are, I think, multifaceted and nuanced, but at its core, what you see happening is that life and annuity players in particular have realized that if you want to be competitive in offering annuities at a competitive rate in the market, if you asset manage better, okay, you can offer higher rates, right? And so there's been a realization that the asset management side of the equation is as important as your marketing engine and your crediting rate to policyholders. And also recognizing the fact that over time, retirement products, annuity products, et cetera, will continue to be very important in the market. And it's just essentially a financial contract. And so it lends itself to this asset management, liability management dynamic. So that's one aspect of it. The other aspect of it is that if you think about all these firms that you and I both know, and you look at the pie chart of where they get their capital from, one of the dynamics of our industry historically was that the pattern of raising capital was we raise a fund, we invest it, we go out and raise another fund, we invest it. And so essentially the capital base has to be renewed every essentially 3 to 5 years. But what's happened is that these firms have also now realized if we can lengthen the duration of our capital base, or in some cases permanentize, right? That changes the equation with respect to capital that we have versus capital that we have to go out and raise. And that's very valuable. So everyone is focused on this question of lengthening duration or permanent capital. And there are others. There's dynamics with respect to how many firms will end up being public. There's the whole private wealth phenomena that we're talking about in terms of the democratization of alts. And how is that playing out? And that's shifting quite dramatically. It's shifting from not only access to those pools of capital, but it's also shifting in terms of product structure.
So you have expanded the firm's businesses beyond its buyout roots, especially with a big push into private credit with your recent acquisition of Angelo Gordon. So tell us about what got you excited about that opportunity.
Well, at a certain point, it was clear that Sixth Street wanted to be their own firm and run their own firm. So we went through a disaffiliation process. And when that happened, we knew from day one that we wanted to be back in the credit business. We knew it was an important asset class in the market. Our clients wanted it from us. We had experience in it. And as from my background here, I knew something about it. And so we started actually looking. And as we were doing that, not surprisingly, the pace of growth in private credit was accelerating. And so when we went public, we realized at that point that we were going to talk about it publicly, that we were going to ultimately be back in that business. We did. And we now had a currency after we went public, which would make it easier for us to do something inorganic. And immediately after we went public, because of this dynamic that you and I were talking about in terms of consolidation, we probably got incoming calls from 25 different credit managers. So we kicked the tires on a lot of things. And what was interesting to us about Angelo Gordon was that it had critical mass and scale.
Has a good brand.
It had a good brand. It had a good track record of investing. Angelo Gordon had gone through a transition already from the founders to the next generation. So everybody there that were in what I think of as the critical seats, in particular the portfolio managers, were mid-career people that have a lot of runway in front of them and had a lot of experience already. And they had a number of people that had come from other areas where they clearly were operating at a very high level. They had a diversified business, which was important, and we felt those businesses were in the sweet spot of where the growth was going to come from in the market. And what was also very interesting was every one of those businesses were undercapitalized, meaning they were out originating their capital base.
Fascinating.
So it was also clear that over time, we could leverage our relationships and our partnerships and bring these credit strategies into those relationships. So that's what we saw in the business, high quality business, undercapitalized, a lot of obvious revenue synergy for us. And finally, a culture that we felt worked in the context of our culture. Human capital deals are tough, but I think they can be done.
Good. Well, I wish you a long and happy marriage, maybe as long as your marriage, which we'll come back to. The last thing on the industry before I talk about your career and leadership, which is to talk about the private equity industry in general. It's still a relatively young industry. You and I have basically been aligned with it for the entire life of the private equity industry. But the period of transition that we're in now is a transition that we're seeing the next generation of leaders and a lot of the founders of these businesses pass the baton to next gen. So I'd love to hear your thoughts about where we are in that evolution.
Yeah, I think that's a fascinating aspect, right, of the business. I mean, particularly for you, because you have covered these firms for a long time. And you've seen these founders from like right in the solid kind of meat of their careers to now sort of passing the baton, as you say. I mean, this industry now has become so important to the movement of capital. And so it's fascinating that we're at the first kind of turnover in the industry, right? Like 30 to 35 years in. And now the first turnover of the industry to the next set of leaders, and also the institutionalization or permanentization, if you will, of these franchises. And some firms have made the switch and some firms have not. And I think that that is going to prove to also be a catalyst that's affecting consolidation. And some firms will survive the transition and some firms will not.
Okay, so let's talk macro for a bit. We're at an interesting moment for markets and for the economy, with a number of different dynamics at play globally. So where do you see interesting investment opportunities today, given that macro backdrop?
Yeah, we're in an environment now that many people have not experienced or seen for a very long time, right? We were in a very low, near zero interest rate environment for a very long time. We're not in that environment anymore. So one of the things that is interesting about the markets is that for the first time in quite a long time, you have what I would describe as a compression in terms of returns between different asset classes, meaning that equity returns, fixed income returns, and credit, as an example, are more compressed today and closer than they've been. So a leveraged loan or a high yield bond might be returning today somewhere in the high single digits and maybe even above that into 10 or 11%. And equity returns today are probably compressed from where they were as a result of things like, particularly in private equity, as a result of things like just what it costs to service debt and the level of leverage. So one of the things that we're finding is pretty interesting these days is what's happening as a result of a significant buildup of levered companies that are controlled mostly by private equity, coverage levels that have come way down, a maturity wall that's developing in front of us over the course of the next 3-4 years, where many of these companies will have to refinance. Not all of them are going to be sold, right? And there's just too much of it. So it's going to take a while for companies to be sold, particularly at valuations that private equity firms want them to be sold. So one of the things that we're finding is opportunities in the middle of the capital structure. We think it's pretty compelling. So for instance, take a sponsor that owns a company where they've got a lot of equity in it. They want to return some capital to their LPs, which they're under pressure to do. One of the things that we're finding is we're seeing opportunities where sponsors, other sponsors are calling us saying, hey, you know this industry, you know this sector, you may even know this company because we may have seen it as a potential equity investor at some point. How do you feel about maybe putting some kind of a PIK preferred or something in the middle of the capital structure? How do you feel about doing something like that? It gives us some capital, basically. We can return some capital that way. And when you look at that opportunity and you look at where you can price that, you can probably price something like that today in sort of mid to high teens. Now, if you think about where private equity sponsors are typically trying to underwrite private equity deals to, they're underwriting sort of 20% plus returns. But in today's environment, we're given the multiples and what people are paying, unclear whether or not those really pencil out to 20% plus returns. So we like the risk reward of that coming into the middle of the capital structure with a strong sponsor underneath you, right?
I agree. I want to rewind the clock. You've had an incredible career trajectory. But let's start right at the beginning. You actually interned here at Goldman Sachs in 1981 in equities trading. So talk a little bit about what you took from that experience. And then I want to talk about your 27 years here.
My summer in 1981 coming here was an amazing experience. First of all, I knew almost nothing about Wall Street. I kind of got here by accident. If I told you about the interview that I had for this summer job, well, the first interview I ever had was on campus at the University of Chicago with a guy named David Lambert, who was at the time, he was basically a research salesperson in equities in Chicago. And the prior summer, when I was still in college, I had come to New York and I was basically stomping around Wall Street trying to find a job. And I could not find a job that summer. This was before my first year in business school. I met someone from Lehman Brothers, and it was actually a woman who was an investment banker, Patricia Kavanaugh. She would never remember me, but I remember the name because this was imprinted on me.
Sure.
And she was the only person who actually gave me the time of day and said, hey, listen, we're not going to hire you this year, but if you're interested next year after your first year in business school, come back. So at Chicago, they had this thing where basically you would bid. It was a point system and you bid on interviews.
That's like law school still does that
right,
today.
Exactly.
Yep.
It's like a self-selection process, right? And so I bid on the Lehman Brothers interview. And Lehman Brothers was coming to interview on campus the same week as Goldman was. But I had this interaction and I was like, that's the only thing I know. Anyway, so I had written letters to all these other firms. And so the week the bidding was open, I bid, and the interviews were 2 weeks later. So I remember I went back to where I was living. I was actually living in my fraternity house. And I went back for lunch one day, and I got a letter in the mail from Goldman Sachs. And it was from a guy named Bill Eisenstadt, who was an investment banker. And I read it, and it was like the nicest letter I had ever gotten. God, I mean,
wouldn't it be great if you had that letter?
Right, exactly. I wish I did. Little did I know it was basically, the letter they sent.
A formal letter, exactly.
The letter you now send to 50,000 kids. But anyway, and I was like, oh my God, it's encouraging and they're sort of inviting me to kind of set up an interview. And so I went to the library that night. I remember I was studying in the library and the bidding closed at midnight on Thursday night for that 2 weeks later interview. And I had already bid and I bid all my points.
On Lehman Brothers.
Yeah.
That's hilarious.
So I'm in the library that night and I'm thinking to myself, I heard about Goldman Sachs. I heard about it from a bunch of people I knew. And I was like, oh boy. 11 o'clock that night, I pick up my stuff from the library, walked to Stewart Hall, went to the basement, which is where the computer center was. And I changed my bid.
Wow.
And I bid all my points on the Goldman interview.
That's an amazing story.
Yeah. And when I showed up for the interview, I walked into the interview center and there was literally 8 rooms and there was 8 schedules that Goldman Sachs had. And 7 of them, this is God's honest truth, 7 of them were by invitation. And the 8th was the bidding list. So in other words, there were 7 rooms where Goldman had proactively invited people to come in.
And they didn't have to use their points for that. Okay.
And I'm
on the 8th schedule.
Right? New schedule, right? Who has absolutely no chance. So I walk into this interview and this guy's sitting in front of me and he's starting to talk to me and whatever. And I'm thinking, okay, Goldman Sachs is an investment bank. And I'm talking about investment banking and stuff like that. And he stops me about 10 minutes into the interview. And he goes, John, do you know what job you're interviewing for? And I said, well, yeah, it's an investment bank. So I'm interviewing for an investment banking job. And he goes, no. He goes, this is for sales and trading. There's a difference between sales and trading and investment banking at Goldman Sachs. And I said, oh. I said, well, look, okay, all I can tell you is that I work my ass off. I'm a motivated person. I know I can be successful. And you just have to take a chance on me.
Wow.
And so the interview went on. And he said, look, you'll be contacted or whatever. And it was great to meet you and et cetera. So I leave the building and I'm like, I'm dead.
Yeah, that was bad.
I'm dead.
That was bad.
Okay, that was bad, right? So anyway, 2 days later, I get a call and they said, we want you to come back to the Chicago office for the next round. I was like, wow. So I go down to the Chicago office, the next week, and I get there and I walk into the lobby of Goldman Sachs, which at the time was in the Sears Tower. And there were 6 of my classmates in there. And
they were invited in.
They were invited for the second round too, right? And so they had a round robin where we all went from office to office to office. So they had us all in the conference room at the end. They said, we're going to invite to New York to interview either 0 or 1 or maybe 2 of you. So we'll come back and let you know. So anyway, 2 days later, my phone rings. We want to send you back to New York.
Fantastic.
And so I was the
rest is history.
I was the only person.
Wow.
And that's how I got here.
So exciting.
Yeah.
That's great that you can actually still tell the story with that level of detail now. Obviously had a big impact on you. Okay, so as I mentioned, you spent 27 years here at Goldman Sachs, and it was a pretty eventful period. The 1987 crash, the tech bubble, the financial crisis. So how did the markets change during that period of time, and how did you change during that period of time?
Yeah, that's a good question. First of all, how did the markets change? I think just size and scale. That's the first thing that comes to my mind. I mean, when you think about sort of just number of companies, size of companies, volumes of transactional activity, financing activity, it changed wildly over that period of time. I remember when I first came to the firm in 1982, companies had to file an S-1 for every financing that they did, including a bond deal, a full S-1. So it was a major event for a company to go through the process of doing that. And then in 1982, the SEC introduced in a trial period Rule 415, which is the shelf registration rule.
Oh, yeah. I totally remember that.
And that changed Wall Street permanently. So what it meant is basically a company essentially file a registration statement that accounted for X billion dollars of securities. And it was like an omnibus filing. And essentially they could then just piece off different financings off of that omnibus by only filing a supplement. And that, by the way, continued to change over the course of the next probably 5, 6, 7 years. When that happened, companies essentially went from being very irregular financiers to accessing the capital markets all the time. Think about companies like banks that were looking to term debt markets for financing. Think about companies like Ford Motor Credit, GMAC. I mean, this is taking us back, right? GE Capital. The level of financing just hockey stick in the market in terms of the use of public financing markets. And it changed the way we behaved with our clients. It changed the volumes of activity. It changed the whole secondary market, exploded as a result of that. So everything kind of lockstepped and changed. The other thing that was really interesting that I sometimes reflect back on is when I got here in 1982, there was not a single PC in the building. There was not a single PC. We had these digital equipment deck, basically like mainframe type things, right, with the paper in them. And so things
Did you have
like
to dial up and put the phone in a...
There wasn't a dial-up then, but because in the building it was wired in. But doing things like a LBO model, you had to get time to go on that computer. You had to then input all of the data by hand and then run the models. And so the other thing that I always reflect on is that I think the first PCs that Goldman Sachs had was like an Apple IIe, and they had one in the computer room on the floor. And so when you think about how quickly that changed with basically people having access to on-desk type stuff and being able to use things like essentially use spreadsheet products. The first spreadsheet
Lotus
product,
1, 2, 3.
Yeah, the first spreadsheet product that this company, Goldman Sachs, used was VisiCalc. Then it was Lotus 1, 2, 3, et cetera, et cetera. The revolution that created also to the extent in the merger market, because you could do so much more so quickly in terms of evaluating LBO models or a merger of equals, things like that. It kind of revolutionized it. So that's another huge change that happened over time. And then the other big change for Goldman Sachs that I lived through here was basically a transition from a kind of advisory agency orientation to a risk culture. That was one of the biggest changes in the history of Goldman Sachs. And it really happened in the mid 90s, from sort of 93, 94, 95 to the late 90s. And you probably remember this as well, but in 1994, this firm had its first really, really difficult year. And if you also remember, in 1994, Steve Friedman, who was the senior partner of the firm, retired that year, and John Corzine became the senior partner of the firm. And John was a trader, and John had a very different risk orientation. And that was the beginning of the transition of the firm basically going from a very risk-averse agency advisory orientation to a risk culture. And the risk culture of this firm really developed and grew into the late 90s and obviously into the early 2000s. And that risk culture separated the firm from most of its competitors.
So I want to talk about the financial crisis specifically, because you were the president and co-chief operating officer during that period of time. And I'd love to hear your perspectives, a moment that stands out during that period, the most important lessons that you learned that help you perhaps lead TPG today from that period of time.
You learn a lot about having to think about preparing to a better extent for sort of these tail events, because they can happen. I mean, sitting there thinking that Goldman Sachs, there was the possibility that 100 and at the time, 30-year-old firm could disappear was pretty remarkable. I think one of the things that stood out for me during that period of time was when we were thinking about trying to raise capital, and we went through the sort of the experience of getting Warren Buffett to invest in our company, and just the dynamics of being part of it and how that evolved with obviously one of our partners and a longtime friend of mine, because he was a college classmate of mine, Byron Trott, was close to Buffett. And, Byron called me and basically said, hey, are we thinking about doing anything in terms of financing? And I said, well, we're thinking about it. And he said, well, Buffett would be interested if we were. And over a period of about 5 days, getting to terms that Mr. Buffett was happy with, getting to those terms was what we were doing. And it was more sort of us adjusting to that than him adjusting to anything. But the fact that basically we were able to raise a large amount of capital directly from Berkshire Hathaway, and then leverage that to doing a common stock deal on the back of that we then increased in size. And the confidence that gave not only the market, but the confidence that that gave people internally and the lift that that gave people. Now, that wasn't the end of it, because obviously the markets continued to be under pressure, and it wasn't really until Hank and Bernanke and Washington decided that they were going to infuse capital in the banks and stand behind the banks. That was really the critical moment. But for us, the other critical moment was raising that capital and being in the middle of that. And I remember standing, if you remember, that was at the time, it was in September, and the IMF meeting, the annual IMF meeting was going on up at the UN. I had to go up to see a couple of clients. I took the subway up. I got out of the subway and my phone rang, and it was Byron. And he said, listen, I've got Warren on the other side of this phone. Are we doing this or not? And so, so I'm standing
That's extraordinary.
We're standing on the street with Byron on the phone, Warren on hold, and I got Vinier on the phone with me. And basically, Warren clicks in and says, okay, like, I'm comfortable doing this if you guys want to do it. And we said, we do. And he goes, okay, I'm good. I'm done. Just call me back with all the terms. I'm taking my grandkids to Dairy Queen. I mean,
wow.
Think about it.
That's Wall Street lore.
Yeah. Think about what we're going through, right?
And he's going to take his grandkids to Dairy Queen.
And so he hung up, and I turned around, went back to the office. David had it all basically, revved up by the time I got back. And we had our equity guys on the phone preparing for the common deal. Anyway, so that was pretty memorable. And then after the Lehman weekend, 2 days after that, I was asked to be on a call with Lloyd. And on the other side of the phone was Jamie Dimon and Jimmy Lee and Geithner. And he said, listen, there's some really difficult things happening, obviously, at AIG. So Jimmy and I went to AIG, and we spent 24 hours straight at AIG with a team from Goldman and a team from JP Morgan. And we did all the analysis in terms of the liquidity hole. I mean, this is a long story, but anyway, we ended up figuring out that they had about an $85 billion shortfall. And so we had a meeting that night with Geithner, who was represented at the time by Morgan Stanley. Bob Scully and Ruth Perot were sitting next to Geithner, and Jimmy Lee and I were on the other side of the table. And he said, well, what have you guys figured out? He said, well, there's no private market solution because there's an $85 billion hole. And they said, okay, thank you. They dismissed us. And that night, the government announced a credit line, basically,
to AIG
for $85 billion, which ended up being, I think, at the end, like 115 or 120 billion. Anyway, so those were some memories.
Extraordinary time. Yeah. You have had a really unique opportunity to take two storied private partnerships public. You were on our Goldman's management committee during our 1999 IPO, which was 25 years ago. And you led TPG through a 2022 IPO, which raised $1 billion. So what did you learn from those two experiences, and how were they different?
Yeah, first of all, it's very helpful for me to have gone through that. And then it helped me a lot think about the TPG IPO. At TPG, when we're thinking about going public, one of the things that I found, and this might surprise you, but many people in the organization really didn't understand what that meant or whether or not we could do it successfully. And so, first of all, giving people the confidence that we can do this and we can do it very successfully, you can't underestimate that when you take a company public, because just the internal sort of enthusiasm and backing and support for the process of doing it has to include that we can become a very successful public company. So you've got to give people the vision that we can do that. That's one important part of it. And we had to actually go through that process here. The second thing was communication. When we went through it at Goldman, we spent a lot of time talking to our partnership. So when we did it at TPG, we did it during COVID. And so what I did is I basically had a series of meetings with the management committee, TPG, and then with all the partnership. And I literally called people by name, one by one, to comment when we had these meetings on, are you comfortable? What are you worried about? Would you do anything different? If I had said any questions.
Right. Nobody would have said a thing.
Nobody would have said a word.
Right.
But
so they all got to process, and they all got
exactly
to share their thoughts.
So that was a very helpful kind of connection for me between the two IPOs.
Yeah, that's great. So who are the people who have influenced you the most? Who are your mentors, and how did you cultivate those relationships?
Probably my dad was an important mentor to me. He taught me a lot about just values and hard work, how you treat people. One of the things that my dad always used to tell me was that the dynamic of treating people the same, no matter whether or not it's somebody who's the CEO of a company or the person that's delivering something to your house. And that has always helped me because I've never forgotten that. So I try to treat people with respect, no matter who they are. And also, I feel partly as a result of that, it's important for me to be available. So if somebody wants to see me, it could be an executive assistant, it could be an associate, it could be one of our most senior partners or a client. I make myself available. It drives some people nuts, by the way, but I do it. So he was an important mentor to me and giving me that baseline. Other mentors that were important to me here at Goldman, there were a few people that were influential, and Steve Friedman was one of them. He was a mentor of mine here. And one of the things that Steve did is he always encouraged me to develop relationships with people junior to me and senior to me, and not rely on somebody who was my boss to represent me with other people who were more senior in the organization. So for instance, like if we had something going on, this was before he was running the firm. I mean, he was running banking at the time as an example. And I can remember, I was talking to him about a client situation, and I said, this is what's going on with this client. And I said to him, can you post so-and-so? Okay. And he said, I'm not posting them.
Yeah, you post them.
You post them.
Yeah.
Go up there, stick your head in the office and tell them who you are. And I've never forgotten that. And I tell you, it's very good advice for people generally, because if you sort of rely on being represented by the person who your boss is, or you're always just deferential to your boss in that respect, and you don't develop your own direct relationships, I think that you miss a lot in terms of being connected into the organization.
Yeah, well, your advice from Steve Friedman, I learned early when I got here, because I was hired by 2 or 3 people who were all gone 9 months after I got here.
Right, exactly.
Like Bob Hurst, John Thornton. Literally, it was just because people like you said, look, we got your back. You're going to be okay. Because literally, if I had tied my star to like one person or 2 people, and they leave, I mean, people are going to, I always give people that same advice.
Yeah.
Building relationships broadly is important. I have to talk about the firm's network, because in my night job now, I lead the Office of Alumni Engagement, and we recently did an analysis and found out that we have more than 220 Goldman Sachs alum who are CEOs, managing partners, or CFOs of organizations that are $1 billion of market cap plus, or with assets under management of over $5 billion. So as someone who grew up here and has been managing talent for a long time, can you share your perspective on the firm's talent and the impact of the network now that you're out?
There's probably only a few organizations like Goldman Sachs on the planet where there has been this orientation around and prioritization on the quality of the people. And that just built on itself over time in terms of who we hired, how we developed our talent. And obviously, as we got larger, it got more institutionalized as well in terms of training people and talent development and exposing people to senior people and things that the firm obviously does a lot now. And even when I was here, the firm was doing. And so I'm not surprised at all in terms of, what's happened as people have moved on. And I also think that the firm's orientation around trying to maintain touch with its alumni, think about how powerful that is. 220 people in positions of influence in companies around the world, and the connection that they have back to Goldman Sachs, their feelings for the firm. I mean, just in terms of like an embedded franchise value of that, it's huge, right? But there's no doubt, like when I think about my training and my ability to actually be an effective CEO of a firm like TPG, this was my only job, basically. So there was so many things that I took from this firm in terms of how to build a business and how to think about risk management and how to think about quality standard and how we engage with clients and the culture around our client orientation and commercialization of things. The importance of the balance between doing things that can also add value and enterprise value to our organization. I mean, there's so many things, and I call on them every single day. And of course, all of us also have to learn how to be adaptive as well, because TPG is not Goldman Sachs. And that's an important thing, which is like I use the skills that I learned and the network that I created and the things that I was able to experience and absorb, but I use that to then try to do what I think is right as it relates to TPG along with my partners to make that organization distinctive. But there are big concepts, though, that follow along, like the importance of culture and investing in culture and things like creating an inclusive environment and a diverse environment and how we source talent, where we source it from, the commercialization of our businesses, what makes sense, what doesn't make sense. So many, many lessons.
So I want to ask you a couple of questions on a personal note. You've been married for 40 years and have 3 adult children. Are there any lessons that you've learned from your family that have influenced your leadership style and the culture that you promote at TPG?
Yes, a lot. First of all, the importance of balance. And I think it's often about making sure that people understand that that balance is important to you and insisting that you're going to go and do that with your family, or you're going to show up at something that you think is really important from your family's perspective. And striking that balance, I think, is actually very healthy. And I also think it extends your career and your longevity. And you start to bring it into different things that you do. It starts to affect sort of your persona, and it starts to therefore affect the culture, particularly if you're the leader of the organization. So I would say that dynamic in terms of the balance that I always felt from my family. I think the other thing is that your family is very grounding. I mean, when you're with your family, you're never anything other than who you really are. And so that authenticity is really important. And if you bring that authenticity to your career as well, I think it serves you really well, because people really understand like who you are as a person. And I try my best to be authentic and not have two different personalities in terms of in the office or at home. But when you're at home, though, you are who you are and you're grounded by that. My wife, Abby, has been an incredible partner to me my whole life. And we've had a very unusual relationship in that we're still best friends after, we've actually known one another for almost 50 years. And so we're still best friends. We're still in love, and we just have a great relationship. And she is always there for me, but sometimes it doesn't have to be like verbal. You just know it.
Yeah.
And I think that that's like a very rock solid thing when you inevitably have to kind of live through some storms and some difficult things. And so I'm very lucky in that respect. And my kids also, I've learned a lot from my kids. I have 3 kids, Jen, Matt, and Jay, and I've learned a lot from them. And my youngest child, Jay, started life as Jane and is now Jay and is non-binary and goes by they, them. And I've learned a lot watching Jay's journey as well in terms of the understanding of the importance of people being who they really are, and how that the ability to be who you are, your true self, unleashes really your best self. You can be your best self when you're also able to be who you really are. And that has been a real life lesson for me as well. I've learned a lot from my family.
Yeah. Well, TPG's lucky to have you as their leader and CEO. So I'm always fascinated to learn what people do out of the office. In addition to spending time with your family, you're actually a bit of a rodeo star. I understand you've won competitions in something called cutting. So what is cutting, and why does that appeal to you?
First of all, it relates to the fact that when my wife and I were trying to figure out where we wanted to be when we weren't at work or we weren't here, and so we decided that we would buy a ranch. And so we went out west. We liked the Rocky Mountains. We liked the things you do out there, so we bought a ranch.
I remember you always had a picture of that ranch in your office.
Yeah, I did, right. And for me, I like being outside, and I like being in sort of like big places. So that has always been a big release for me and a stress reducer for me, and something that I really enjoyed. So after we bought the ranch, I learned how to ride horses. And my wife knew how to ride. I didn't really know how to ride, but I learned how to ride horses. And then we had somebody come to the ranch once, and occasionally we did this when we had friends and family, that we would try to have something interesting happen at the ranch where people would see, oh, this is interesting. I've never seen that before. And we had this person who basically competed in cutting horses. Well, cutting horse basically is a competition where you have a herd of cattle in a pen, and you ride into the herd, and you basically separate out a cow. And cows are obviously herd-bound animals. When you separate a cow out of the herd, that cow wants to get back to the herd. And the idea of cutting is basically your horse keeps that cow from going back to the herd. And again, all of these rodeo-related types of events or equestrian types of events in Western horses all come from something that cowboys actually really do. So if you raise cattle, as an example, very often you have to separate a cow out from the herd because you either have to doctor it or you're separating out cows and calves, but it's all turned into sports. It's all turned into different, competitive events. So cutting basically is you separate a cow out from the herd. In 2.5 minutes, you have to cut at least 2 cows out of the herd and do it. And there's rules on how you quit that cow and go in and get another one. Anyway, so I saw this guy do it, and he said, hey, do you want to try it? So I got on this guy's horse and I did it. And I was like, wow, this is really interesting, because when you're on the horse, what you find out is how athletic they are and how powerful they are. And also, if you have a good one, how smart they are. And so anyway, I got interested in it from that. And I said, I'm going to try to do this competitively. So one thing led to another, and I got into it, and I did it. My wife did it. My oldest daughter did it, and we got pretty good at it. So anyway.
Who would have thought?
Yeah.
All right. So I want to end by asking you a question about, you've given us so much good advice for our listeners. What advice do you wish you had been given when you were younger?
Well, you touched on it before, which is the importance of developing relationships. I think when you're young and you get into the business, you're so laser focused, right, on doing the model, doing a good job, creating the output that you need to create, that you do, I think, underestimate the value of creating relationships. And that can be with people in the firm, people who are older than you or more experienced than you, people at other places like clients or things like that. The value of creating relationships, I think, is a very undervalued thing. It's also an undervalued skill. I mean, you created relationships for a living for a lot of your career. And I think you do it at a very unusually high level. But I think that the value of that, just in terms of your own learnings, your own development, the impact on business that it has, because people fundamentally want to do things with people they respect. And also, again, back to the richness of your experience. I mean, think about the clients that you're close to and what you've experienced as a result of that. I mean, your career would be totally different if you didn't have those relationships. So I think that that is something that I undervalued in the early parts of my career. I had a reputation for being pretty laser focused, and even in my early times of my career, I had a little bit of a reputation of sort of like it was like my way or the highway in terms of like making decisions and things. And eventually you realize that other people matter. That's
good advice.
Yeah.
Other people matter.
Yeah. So anyway, I would say that probably would have benefited from that earlier on.
Okay. Well, such a pleasure and so much fun sitting down with you today. And thank you for being so genuine and sharing so much about your life and your perspectives. This is really fun.
Yeah, well, thank you, Allison. And it's always, again, it's a thrill for me to be able to come back and talk to you about stuff like this. And I mean, my relationship with you has been a very long relationship, which I value and I've enjoyed. And my relationship with the firm has been a big part of my life. So thank you.
So thank you all for listening to this episode of Goldman Sachs Exchanges, Great Investors. This podcast was recorded on June 13th, 2024. I'm Allison Mass. If you enjoyed the show, we hope you'll follow us on Apple Podcasts, Spotify, or YouTube, or wherever you listen to your podcasts, and leave us a rating and a comment.
The opinions and views expressed in this program may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Each name of a third-party organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. The content of this program does not constitute a recommendation from any Goldman Sachs entity to the recipient and is provided for informational purposes only. Goldman Sachs is not providing any financial, economic, legal, investment, accounting, or tax advice through this program or to its recipient. Certain information contained in this program constitutes forward-looking statements, and there is no guarantee that these results will be achieved. Goldman Sachs has no obligation to provide updates or changes to the information in this program. Past performance does not guarantee future results, which may vary. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program, and any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed.